Hello traders and investors, welcome back to the Trend Trader channel. So today I want us to cover just something relatively small. So basically what I want us to discuss today is how can you lose money in the stock market. Depending on the people that you engage, we answer questions in the comment sections, we engage people in the social media, in different social medias. Some people, they ask how can they lose money in the stock market. We believe that the context that they are asking on is whether the broker that they could be using can just disappear with their money. As you know already, I personally use is equities, so the answer that I always give is that they've got nothing to worry about their broker if they use is equities. Also, not everyone is using is equities. Some people are using their banks as their stock brokers. So we also sort of trust banks as stock brokers because they are regulated. Basically, any institution that is regulated, we would want, well, we will sort of trust that institution that it is not going to disappear with our money. But I'll just give you a breakdown of what we are going to be talking about in this video. In this moment, I just want to ask you that you click the subscribe button if you haven't subscribed yet, and also if you enjoy the content of this channel, whichever content, whether it's this video or the past videos, just give this video a thumbs up. That really helps the YouTube algorithm to spread the video so that it reaches a lot of people. So thank you for subscribing. All right, so back to the question of losing money. Like I said, the first thing that you want to address is that you need to ensure that you are using a regulated broker like is equities or your bank, but there are other financial institutions that offer stock brokerage like PSG. There's F.I.R.E Capital. It's just a plenty of brokers out there. The way that they differ, it could be the commission that you pay for trading or the fees. Some brokers, they have monthly management fees. Some brokers have high commissions. Some brokers require you to spend a minimum amount whenever you invest. So one of the reasons why most retail investors use is equities is because there's no monthly minimum fee. There's no monthly management fee, meaning that as long as you have a portfolio, is equities will not expect you to pay some money just to keep your shares with them. Number two, the commission on is equities is just low. I've been using is equities for as long as I can remember, so I know that the commission is just low. I think it's about 0.25%. What are the other advantages? Well, it has its own disadvantages. There is no broker that is perfect, but if you're using easy equities, you have nothing to worry about losing your money in the stock market, meaning that your broker is not going to run away with your money. So now let's go to the crux of the matter. Now, once you've bought shares in companies that you like or just companies that you think are going to make money for you, how can you lose money? So by losing money, I will describe it in two parts, right? So there's a part where I will be talking about not necessarily losing money in terms of value of your invested capital. Then the last part will be about losing money where you lose some part of your invested capital. Hopefully you don't lose all your money, right? So the first part, where you lose some money or you can make some money, but you're just going to lose the ownership of your shares, right? When we buy companies, we buy them for different reasons. We could be buying a company because we think that it's going to be a great company, so we expect the share price of that particular company to rise. Then we buy that company. Sometimes we just buy the company because we like it, we use it. You go to ShopRite every day, or you go to Checkers, or you go to Game, or you go to Macro. So you know that company, or you bought your car from a combined motor holdings. So you know that company. You are just buying that stocks or shares in that particular company, right? The assumption is that you have done your research. Whatever that you define as research, it could be technical analysis like I do, it could be fundamental analysis, it could be a combination of technical and fundamental analysis. Whichever approach that you use to decide that, okay, this is the best company where I'm going to put my money, right? You've done your research. The problem is nobody can predict what is going to happen tomorrow. Literally, no one. When I don't even think that traditional healers or traditional doctors can help you with that one. But the point is, no one can predict what is going to happen the following day. So today, you buy shares in Sasol, for example. Now you own Sasol shares. Then anytime after purchasing your Sasol shares, it doesn't matter whether the value of your investment has grew or it has declined. But after you own those Sasol shares, then one day you wake up, you read stock exchange news services, what is normally called SENS. You read that there is a company that wants to buy out all the minority shareholders of Sasol, right? Normally, companies are governed by Companies Act. So basically, if one shareholder owns about 35% of the shares, then by law, they should, I'm not sure if it's a must, but they're expected to buy out the minority shareholders. So some companies, they will buy, or some investors, they will buy more shares so that they reach that threshold. And then once they reach it, then they trigger that clause and they offer to buy out the minority shareholders. Minority shareholders is any shareholder that is not holding 35% of the shares of that particular company. So now, if there is a buyout offer, right, there are two things that can happen. Number one, the offer price can be higher than the current trading price, not the price that you bought your shares at. The current trading price. In this case, I'm using Sasol as an example. The current share price of Sasol is about 260 Rand per share. So if a company comes and say they are buying out the minority shareholders and they are going to pay a premium, meaning that they are going to pay more than what the current share price of Sasol. Let's make an example. They say that they will buy out the shareholders. They will offer them 300 Rand per share, meaning that there's a 40 Rand premium. So that's a good buyout. Well, in my opinion, that's a good buyout because it means that I'll be getting more money than what Sasol is currently trading at, right? So these kinds of buyout, they normally succeed because they are offered at a premium. The people that want to buy out the other shareholders, they have done their own research, their own due diligence, and then they've come to the conclusion that for them it's the best offer, or it's the best thing to make. It's their own best decision, right? So in that thing, if that offer is accepted by the board of Sasol, then if you are a retail investor like me, you have few shares in Sasol, basically you don't have really much to say on whether that transaction should go on or it shouldn't go on. You find out that the other shareholders that have more shares than you, they could be interested in that transaction and they approve it. So in that way, it means that sometimes when they buy out these companies, the intention is to delist those shares, right? Meaning that they want to take them out of the exchange. In this case, we're going to make use of the JSE as an example. So they want to delist those shares from the JSE. Once the company is no longer publicly traded, it becomes a private company, right? There are people who can invest in private companies, but for the most average Joe, it's not easy to invest in a private company. The benefit of investing in a public company is that JSE has some regulations. It forces those companies to report every 6 months, among other things. If the directors are making transactions, they are forced to make an announcement of that transaction. Basically, it's much easier to invest in a public company. I haven't invested in a private company, so I'm not going to say it's difficult, but it's much easier to invest in a public company. So in that case, you're not going to lose money. You are just going to get back your invested capital, maybe with a bit of it. The assumption is that you bought Sasol below 260 Rand per share. If you bought Sasol anywhere above 250 Rand per share, then what's going to happen? You're going to get less than what you invested. Let's say you bought Sasol shares at 450 Rand per share. So now if the current share price is 260 Rand, it means that you are still down. You haven't even break even on that Sasol investment. You are still under. Even though the offer is a premium to the current share price, it's still lower than the amount that you paid. So since you're going to get back less amount of money than the amount that you invested, then you're going to lose that difference, right? So just a quick recap. You can make or lose money if there is a buyout, meaning that a majority shareholder is offering the minority shareholder to buy their shares at whatever price. The best case scenario is that they want to buy them at a premium, meaning that they're going to pay more for that. One of the recent transactions that it hasn't happened yet, but it's on the card. There's a Canadian company called Volaris that wants to buy out all the minority shareholders of Adapt IT, right? So their offer price was 7 Rand. When they made that offer, Adapt IT was still trading below 4 Rand or 5 Rand, but definitely it was trading below 5 Rand. So now they're offering more. I think that Adapt IT investors are probably are probably interested in that transaction. Personally, I have never experienced that a majority shareholder offered less money, like a discount to what the current share price is trading at. I think one transaction that happened this year where I had shares was Imperial Logistics. The transaction hasn't been concluded, but I bought Imperial Logistics at about 30 Rand per share. Then after a while, there was an offer saying that there's a company that wants to buy Imperial Logistics shares at 62 Rand or 63 Rand per share. So that was almost 100% jump. It was about 62%. I've since exited my position, but I kept that profit. Like I said, that transaction is still in discussion. They haven't concluded it, but I made money, right? Okay, then the other companies that majority shareholders buy are not necessarily good or bad companies. They are just trading at a low price, right? Remember, we are in South Africa, sometimes the rand is weak. Some of the companies are foreign companies. It could be US companies, or in the case of Adapt IT, it's a Canadian company. So if those companies, they think that it is cheap to buy a certain company, not to say that the share price of the company they're interested in is cheap, but just the rand US dollar exchange is just so low for them that it's easy for them to just buy out that company. So if a company is trading at a discount, for example, the market is just not entertaining that current share, then even the board of that particular company can just decide to delist it, right? So when they delist that particular company, right, sometimes they give you an option to keep your shares in a privately owned company. But like I said, privately owned companies are not a walk in the park like publicly traded shares. Well, it would be a shame if you are offered less than what you paid for that particular company. But what I want to highlight is that not all buyout result in a premium, right? So now we are on the second part. Before we go there, again, please consider subscribing and liking this content. Just like this video, subscribe, share it with as many people as you can, right? So now the second scenario is the one that a lot of people are not interested in talking about, right? In this scenario, that is when you sell your shares for a loss. So I'm just going to describe what I mean by that. You buy a company, the company is trading at 100 Rand per share. Your expectation is that the share price is going to rise. But for whatever reason, the share price, it just keeps on falling. It goes to 90, it goes to 80, it goes to 70, right? While the share price is dropping, you haven't lost money. It's just that the value of your investment, it keeps on decreasing. Let's say, for example, okay, we said the share price is 100 Rand per share. Let's say you put in 10,000 Rand, you have 100 shares. I hope that math is correct. So the number of shares that you own is still the same, but the value of your investment, initially it was 10,000. Once the share price reached 90 Rand per share, the value of your investment now is 90,000. If it drops to 8 Rand per share, the value of your investment is now 8,000, right? So now there are two ways, or at least two ways how you can lose money, right? The first way that you're going to lose money is when you decide to sell those shares. Why would you want to sell those shares? Some people like me, we use a stop loss. I normally don't allow more than 10% drawdown whenever I buy something. So if I'm buying something that costs 100 Rand per share, my stop loss is going to be somewhere around 90 Rand per share. So if the share price drops to 90 Rand, it triggers my stop loss. Then that position is closed. Whether I'm using a broker that allows me to set a hard stop that will be triggered automatically, or I use a broker like these equities where I have to log in and sell my shares at a loss. So that is how we lose money, right? The reason for losing or for using stop loss is that you accept that a small loss. The main goal is to preserve your capital. You want of that 10,000 that you invested, I want to have at least 9,000 that I can use to take another position elsewhere, right? So that's how a stop loss is triggered, because the share price was declining. Number two, not using a stop loss. Some people don't use a stop loss for whatsoever reason. It could be that based on their analysis they are buying undervalued companies, so they think that there is a cushion for the share price to drop, but also the company as a business, it still exists. So to them, it doesn't matter what is the share price of that particular company. As long as the company is operating, hopefully it remains profitable, it pays them some dividends, so they don't really care much about the share price. But you know, emotions sometimes they overcome us. You log into your easy equities account, you see the value of your investment, it has dropped. Now the emotions start to kick in. You had 10,000 in a particular company, now it's 7,000, now it's 6,000, now it's 5,000. Sometimes the emotions they just overpower you to a point there to decide that, okay, I'm just going to close this position, forget about this company, and go look for another position elsewhere in another company. I mean, if one company is falling, every day there's another company that is moving up. That's how the market works. Some companies are going up, some companies are going down. It's not easy to always be in the companies that are going up. Hopefully you are not in all the companies that are going down. So in that second scenario where you sell because the share price has dropped and now you can no longer handle that loss in value emotionally, then you sell your shares again now, because you're going to get back less amount than the 10,000 that you put in. That is how you are going to lose money, right? To the first scenario of triggering the stop loss, the reason I use a stop loss, it is my risk management tool. We've made plenty of videos saying that in the stock market, risk is inherent. It's always going to be there. You can't run away from it. You can convince yourself that you can deal with a risk by having strong emotions and not buckling down under pressure if the share price starts to crash. But there are so many ways that people manage risk. My way of managing risk is by using a stop loss. So to me, a stop loss is a risk management tool. Alright, so now I hope that you understand what it means or how you can lose money in the stock market. Number one, as long as you are using a regulated broker, you wouldn't worry that much about your broker running away with your money, or even if the company that owns that stock brokerage firm, if they go down. Remember, there are some clauses. They're supposed to separate clients' money from the company's money. For example, if you go through the easy equities, there you will see they say something about funds being ring fenced. So easy equities is part of People Group. If, for example, whatever happens, hopefully it won't happen, People Group is struggling financially and they have to close shop, it's People Group that is going to close. It's not your investment that is going to disappear, because your funds are separated from easy equities funds. So it's important that whenever you want to choose a broker, make sure that you choose a broker that is regulated. One of the ways of checking how a broker is regulated is by looking at their financial service provider's number. They normally cite their FSP number. They say that they are authorized to do a stock brokerage. You take that FSP number, you go to the Financial Sector Conduit Authority FSCA website. Somewhere in the website you can find a place where you can search that particular FSP number. Then you will see, in the case of People Group, it will show you that First World Trader. Remember, if you know easy equities, you know that easy equities is a trade name for First World Trader, which is also owned by People Group. It's just a combination of things. So when you search, don't expect to just see easy equities. If you see People Group, don't be alarmed. If you see First World Trader, also don't be alarmed. It's still the same company. So once you have verified there with the FSCA, now you can be a bit confident that the broker is not going to disappear with your money. Then you just look for that clause that the funds, you just look for the clause that says that the funds are ring fenced, meaning that your broker's money is separate from your money. Then now the second part that you have to deal with, you need to understand if there is a buyout clause. Whenever the majority shareholder wants to buy you out, the best case scenario is that they are going to pay a premium. So in that way, you're not going to lose money. You're just going to stop investing in a company that you like, right? Sometimes it happens that they offer you less money for whatsoever reason, or they offer an amount that is lower than your enterprise. Then you are definitely going to lose a portion of your investment. Then the second or the last portion of it is when it's either your stop loss is triggered or your emotions forces you to trigger the stop loss. What I didn't cover is margin call. In this channel, we don't really talk much about trading leverage product, but the other part of losing money is if you're trading leverage product and you're trading, well, leverage means that you're putting less money, the broker funds you. So once you run out of money to maintain that position, then the broker is obligated to close that position. So there it's just end game. You can lose money, right? So I hope that now it's clear how losing money in the stock market works. Once again, if you enjoyed this content, please like, subscribe, go to the comment sections, ask as many questions as you want. We'll try to answer all of them. Thank you. We will see you in the next video.